There was a company, the founder had raised a total of $3 million, and he was grinding away. And I met him at a founder event, and he says to me, I think I'm going to be getting an offer for my business. I said, okay. He goes, I think it's going to be around $100 million. What's our time frame? He's like, I'm hearing that I should get this in 4 or 5 days. And I said, do you care about paying taxes? He goes, I don't want to pay taxes. We literally had a sprint. The following night, we created a structure that allowed him, he lived in a high tax state, that allowed him to not pay tax on the transaction in his state, which was a 10% savings.
Welcome to the show, and thank you for putting up with the technical difficulties there in the beginning. Appreciate it. So I guess before we get into what you're doing now with Pinnacle Wealth and how you help business owners and the succession planning and building lasting wealth, maybe talk a little bit about growing up, your experiences, and what helped shape your perspective.
Thanks, Joe. Thanks for having me. This is a great setting, and if we don't have technical difficulties every day, what would life be like? It was interesting growing up with a father that was a partner with his brother and the grandfather in this family business. I didn't know it was different than anything else. And so as I went to college and got into business, and people would talk about, I grew up in family business, and I hearkened back to those memories and that thought process around what I absorbed without even knowing it. There are big lessons, there were micro lessons that I learned about people, about operations, about process, about the customer or client, how important they are, and knowing that every time we walked into the store, we had to look presentable. As kids, he was the front man in terms of the connection with customers and employees. It was a great place to learn business.
Yeah, family businesses are very unique. Business is tough in and of itself, and sometimes there's this outside view that, oh, it's family business, you're not really working, you're not really doing. And it's no, maybe that's not the case. Anyone who's grown up in a family business, because maybe labor laws don't necessarily apply. Maybe you're doing,
there were none.
There were none, and you're wearing so many different hats. But what are a couple of lessons you think you learned that most CEOs and founders don't understand, not having had that experience?
Mm-hmm. Growing up, the malls and a lot of stores were closed on Sunday. So we would, a couple times a year, do inventory on a Sunday, counting everything, double counting everything, and then having someone triple count. And going to work on a Sunday wasn't like pulling teeth, right? That's just what you needed to do. There'd be times when we'd be at dinner and a phone call would come from the store manager. The alarm just went off and someone threw a brick through the window and took some stuff out of the window. The phone call comes in, you're at dinner, you talk about it, you hear about it, you learn what's going on, what's next. It's just,
it's a constant. It's never really off, right?
No.
It's not a job. And from the CEO level, it really never is off, but going up in mid-level executive and whatnot, there is still that ability to step away and it's someone else's problem. Maybe.
But to your point about the dedication of a family business, when you have your name attached to that business, and where we were 25, 26 stores all over the state, we had an importing group that we created out of Southeast Asia with 350 stores across the country. And there's pride. You're proud. You are doing whatever it takes to further the goals of the company.
Talk to me a little bit about some of the mistakes founders make when they start having success.
So my approach has always been with founders is recognizing that they're no different than all of us, right? They can get very myopic and very focused. And that's a good thing when you're starting out and you're focused on that product or that service and you want to make it right for the marketplace. But as that company grows, that entrepreneur doesn't have the necessary skills to be able to grow that company. As you're seeing success, we're having issues below because an entrepreneur is great at starting the business, has the idea, has that passion, but is not so great with business management. So what I want to be able to do is take a holistic view of what they're doing, and that's from their personal life, their business life, and then focus on opening up their blinders a little bit and just getting to see some different mistakes that I see. Look, there's no perfect business being run, but more importantly, the mistakes I see are on the personal side. I created this concept, and I have a client up in Dallas who were right in the thick of this. We started their estate planning. They're now, and I'm helping them with this, raise about a $10 million raise to expand their concept. And the valuation of their company has tripled. Now we're at a different level of need for planning. And I'll just use the big term estate planning. And so as that business grows, they don't have the corresponding knowledge about what needs to occur in their private side to manage this wealth. Now, they may not care. They may be, I don't care what happens to the money. I don't care what happens to my kids. I don't care. I don't mind paying taxes, but rarely that's the case. And so by sitting down with them and giving them some thoughts on what the future could look like and steps along the way, it gets them to think about it, and it allows them to have some thoughts inside their head before we have those conversations. And so this couple up in Dallas, when we started looking for the money, we started interviewing investment bankers. And once we got that in place, we need to have another conversation about the next steps. And look, there are a lot, as you well know, there are a lot of estate planning techniques. A lot of them are very confusing. And so I really get that founder or business owner not to think in terms of an attorney. I need a trust and I need an No, we just want to understand what it is you want to do. What do you want to accomplish? Form follows function. So by downloading that information to me, I'm able to have that conversation with the attorney in advance to the meeting. The attorney can ponder, can think, can create some ideas. So when we get together, we're not just on step 1, who are you, what do you want? We're on step 3 and 4, thinking about ideas, thinking about plans, thinking about structures to talk about. So our meetings are much more efficient and we just get more done. Because this couple up in Dallas, they're busy. They're running a fast-growing chain. They're hiring, they're finding locations, they're raising money, they're busy.
Right, yeah, and the whole thing about planning that sometimes in estate planning people don't understand is that means you have to sit down and have conversations, right?
About death.
About maybe who in the family could take over, or is it going to be put into a trust, is it going to be sold off? But being so myopic, like you said at the outset, which is easy to do because all these little fires, all these little fires need to be put out. Are those conversations had 3 months out in this scenario at this level, 6 months out, a year out? When do you suggest people start having these conversations?
So for instance, this couple, they were headed for 10 days to South America. And they were concerned, we're going to be on the same plane. What happens if?
Yeah.
So that was their focus motivation, right? It could be somebody who...
Fear.
Yeah, we have fear and greed.
Fear and greed. Good motivators.
They're the top 2. And so that starts the process. If somebody is beginning to think about transitioning out of the business, in a perfect world, when they start thinking about it, I want a phone call. Because here's why. This is where I think a lot of wealth advisors don't capture this opportunity for a variety of reasons. When that business owner raises her hand and goes, I'm thinking about the path to getting this and selling it. It starts off a whole chain of events. And really where I start is, at a very base level, is who would buy you? Let's start thinking about who would buy you. Let's start in your tight circle, your industry group. You've been in this industry 30 years, all the players, right? Let's put some feelers out. Let's see what we get. First place. The second piece is the business ready to sell. Have you cleaned up the books?
Yeah.
Do you have all your personal stuff off? Look, we don't need audits, but maybe quality of earnings. Let's get that squared away and done. We'd rather do it ourselves, one, to find problems, solve those problems, and be able to go into the data room and say, hey, you got a quality of earnings or an audit in there, and that's like the biggest checkbox you could get.
These aren't the things you want to come up during due diligence. You want it resolved before the data room is all populated and ready to go. So at a bare minimum, disclosure is properly made, but ideally it's fixed.
And so we have, right, who's going to buy it? We're going to get the business tightened up, all right? And that could mean changes of ownership or the next piece, which is the estate plan.
Yeah.
And then we begin to think about all of the tax saving opportunities, the abilities to defer. It's a whole playing field of things we can choose from.
Give me an example of a painful situation where someone just waited too long to make those steps.
There are a lot of those because it's 95% of
Really?
Right. Because
wow.
Because I had this great conversation. A good friend of mine up in Washington, he bought a winery. And he bought the winery, and it was a great buy. It really was great. A couple months ago, he said, I'm ready to sell. I found the market. I know where I am. And I said, have you gotten all your data ready? He's like, yes. What I did, and he's really smart, he said to me, he said, yes, I started day one preparing the business for sale.
Oh, wow.
So as I moved
Long
through all my
horizon.
processes, I got a contract. It went.
Wow.
I did, and
That is rare. That has to be rare.
Super rare.
I'm an M&A lawyer. You go to clients who are like, we want to sell next week. I'm like, great. How's the data room look? What's the data room? That is amazing. And so you get a higher valuation. You get a cleaner, quicker exit, right?
Now, here's what I didn't mention before. When that founder raises their hand, is I have a conversation with them about where are they in the business cycle. So we've got that business cycle, right? And we're either coming up here, hit a peak, or we're down here.
Right.
Because we want a good transaction, we want a fun transaction, we want an easy transaction, we want a high value transaction, and we want to be in a position to where we're in this phase. Now, if we're here and our industry is contracting, it's slowing, then that conversation is, do we sell here or do we wait for the next cycle? And founder, what's the cycle look like? Because they've been living it.
Right. Yeah.
And so having that, so if we start way out here, we can see the future and go, okay, let's do this here, or we need to wait. Now, the thing that ties it all together is I will do a very comprehensive plan, financial plan. So what I'll do is I will get all their personal information, create a financial plan.
How long does that process generally take? I know some are more complicated than others.
Yeah, gathering the information takes the longest. Because once I have the information,
3 months?
a month, it can
Okay.
take a month.
Okay.
And I can have it done in a week. I just got to have the info.
Okay.
And then we take that business and we do a high and low valuation, just back of the napkin, load that in, and then run. Because what I want that founder to see is we start that process, and at the end of the process, you're going to have X in your hands.
In your experience, do the majority, are they disappointed by that number or are they surprised that it's so high?
I have had a handful of disappointments, but I knew going in that the data was going to tell me they were going to be disappointed because of the issues they were having in the business that would hamper evaluation. I've had a couple of founders break down and cry because the number was 3x than they need. So here's what happens. So we do that process and they go, okay, I'm going to have 3x, and we haven't done any estate planning or tax planning. Now, so we do that, maybe it's 4x. But more importantly, that transaction for that founder should not be stressful. That founder doesn't need to be stressed out about, and I make this joke, about the inventory on paper clips when I sell. I don't care because I'm getting 4x. Geez, if I have to give something back and I get 3.5x, right?
Would you say the majority, you look at them and you say, if you want that number, it's going to take 1 year, 2 years, 3 years? Because if 95% have sloppy books and records and there needs to be some cleanup, that does take time. But bigger changes at the business level and to have that bleed through and affect earnings and then be able to show it for a couple of quarters, that's a harder task. Would you say was it 50-50? Was it the majority?
What's interesting, I don't think, and again, in my opinion and experience, I don't think founders go, oh, I thought of this idea and I need to get 10 million out of it, right? Because they're founders building to solve a pain point or a need. And so they're solving to fill it. I don't think that you could look at any of these founders, even in Austin, and go, did you expect a $40 million payout? And they'd be like, no, because you really don't know what's going to catch fire or not.
Yeah.
And we have to overlay the economy.
There's so much outside of your control in that regard. And that has to be tough in someone in your position because it's an objective analysis for the most, because they're coming to you and their cycle is their cycle, but the business cycle is a completely different thing, the environment. And so they could have everything in order and everything's great and everything's humming, but it's just a bad cycle for the industry. And so you're saying, yeah, if you'd done this 3 years ago, it could have been 5x, but in this market, we're looking at 2x.
A couple of things around that. I had a client, and it's a huge, great story, but the one little snippet out of it was in '06, he wanted to sell his business. And at the time, it was worth about $750 million.
Wow.
And he was choosing between two bankers, Goldman Sachs and Morgan Stanley, and he literally flipped a coin to pick between one or the other. And at this time, both firms were solid and doing great work, and it is a 50-50 choice. He ends up choosing Goldman, and they fiddled around and they missed the market. '07 popped up. Now again, that happens.
Yeah.
So the valuation went to 400 million, and no different than all these parallels, no different than you trying to sell your home.
Mm-hmm.
You're trying to sell your home for 1.5 million, and then you wake up next day it's worth $1 million, and you're like, no, I'm not going to sell it. I'm going to fix it up. I'm going to go to Home Depot with you.
Good luck. Yeah.
He did some radical changes in the business, okay? And then he called me one day and he said, I did it. And I said, what did you do? He said, I sold the business. I said, you did? Who'd you use? And he goes, I did it myself.
Really?
I negotiated the transaction for cash for $1.1 billion.
Wow.
And so he missed the market.
Yeah.
We huddled with his exec team and made some changes, and then a handful of years later went back and he went to a competitor, struck it up, and sold the business. Again, who knows? And so now he's worth 1.8 billion. He's on the Forbes honor roll. We were able to do some great things while he was running the business in terms of taxation, in terms of pulling money out.
What do you think he did to get that valuation back up higher than it was pre-crash?
And I think there's some parallels to what we're seeing today in the global markets. We had '07, '08, and when we have dislocations like that, there's a saying in my world that all correlations go to one, meaning risk. When there's risk in the world and people don't want to own risk, they sell. All right, and so we have that temporary drop. We saw it in April with the tariffs last year. We saw it with the bombing. We don't know how long this is going to go on. Market's hammered. We can't have that. I got to end it. I got to have some rhetoric. And we bounce back up. I think oil hit 115 trading.
Big swings.
Right. So I think what we have to realize as investors and owners is that these downdrafts are temporary. And when we understand what caused them, did it affect our business on a first degree level? Yes or no? No. But what happened in '07, '08 was a terrifying experience. But what he went and did, less about global markets, what he went to do is he had already identified problems in the business. And a big one was his engineering department was not at headquarters. It was an offsite location 2 hours away by plane. So he's an engineer. So what he did is he went back into the lab, basically moved engineering back to HQ and spent every day in the lab.
Wow.
Building, creating, and thinking. And that alone strengthened the business. By this time, he had a full C-suite, so they were running the business, the operational day-to-day. He was still monitoring, watching, involved, but they were doing things he couldn't do, so he could go do things he wanted to do. And that was a focus. Once we built that C-suite up, the focus was, think about what it is you want to focus on. And he was like, oh, that's easy. We're going to move engineering back down to headquarters. I'm going to get into engineering. I got a new engineering guy, because we weren't pushing the ball forward.
Wow, that's amazing, because it seems like such a simple tweak or change, and you wouldn't expect it to have that impact. And that's definitely a case study against remote work, right? It's just like Elon Musk says, you can't call it in, right? That is astounding, because it wasn't just that he got a little bit of an upside. He completely went into a different bracket because of that. He's attributing it to bringing that back in-house, essentially. You uncover financial blind spots in business. What do you see as the biggest, most common blind spot in the majority of the businesses that you deal with?
They are not focused on the ramifications of a sale, meaning whether that's from a tax perspective, a personal perspective, their spouse, their kids, their family. I'll talk about this client who sold for 1.1. I spent a lot of time with him. I'd go to his town once every couple, not only to review, but to plan, to strategize. We talk about his business, we talk about investments, global markets. And he has 2 children. And a lot of our conversations were around, look, I already have $500 million in the bank because we pulled money out of the business. And that's a lot of money. And I don't want my kids to be ruined by this amount of money. And the kids eventually found out when their dad bought a new jet.
Dead giveaway. Dead giveaway.
Yeah. That took more than one pilot. He's a pilot, so anyways. And so I think there's a lot of those soft issues that, again, professionals, advisors Either they don't have that experience to have those conversations, they don't recognize those conversations are incredibly important, and they just don't know to have them. And so having those conversations around the impact of a transaction and how to think about it. I get them articles, I get them books, because if their viewpoint is this and we need to open it up, I may need to use more tools than just my persuasion. So I'll send them articles, I'll send them books to, again, open those blinders. And so I think that's the most important part, is they don't really understand the ramifications because they've never done it.
No, not only have they probably never done it, maybe it's their first big exit, but it is something that's never addressed. You're talking about the psychology behind it. You're talking about the emotional impact behind it. And I think they're definitely lucky to have someone like you who recognizes that, because I would imagine most wealth advisors don't even address it. Let's talk about maybe a 5 to 50 million, maybe $100 million exit. By any measure, that's still
A lot of money.
Just talking about that, what happens to a person emotionally when they get that exit? What's a common thing that you see?
I like to talk about the future with that founder. One of my clients up in Dallas, he is in the process of selling or attempting to sell. He's the CEO of this fast casual restaurant chain. And we have conversations. Okay, here are the three scenarios, right? Someone buys you and fires you. Someone buys you and keeps you. Someone buys you and you quit. You want to do something else, right? So let's talk through each of those. What's the probability? What could happen? How does that make you feel? What would you do? I want them to be thinking about things post, because guess what? There's going to be squirrely things happening, right? We may be going down this right path and then we got to turn left and then right again. And I want those founders to be thinking about all these possibilities. We won't get them all in terms of what's in the mix, but I want them to think about those, because what it also does is, again, it opens up their mind to different possibilities. And one, they might go, oh, I love this one, let's go do that they didn't think about before, because they were only focused on, I got a sale, I got to get this sale done, I'll worry about what happens after. Now, the other important thing is, we got a business transaction we're trying to do, we got a personal side we want to do, and we want to follow a dual track all the time because they're related. And so that's where founders slip up, is they don't understand the power and the impact of what they can do on their personal side. So the biggest complaint I get is, I cannot believe I have to write this size of a check to the government. Now, it's not about, I can't believe I got all that money, but I can't believe I got to write a $7 million check. That's more money than I've seen in my life. And I'm having to, when it's too far, you then have to rationalize the $7 million check. But if you can share stories about other founders, about what they felt and what they went through, I felt it with them, then that helps with their understanding of that emotion, and they understand that I don't want to feel that. Whether it's a $2 million check or a $40 million check or whatever that emotion is, how can I get around it?
Wow, interesting. Sticking on the same theme of psychology, how often do you see it, because you're dealing with strong personalities, how often do you see it that a founder's ego will destroy the valuation or maybe destroy the deal completely? Is that ever an issue?
Yes, without a doubt. If you're getting down to the end and the ego is not in check and the buyer doesn't warm up to that ego, then it's too late. You're probably not going to have a transaction. I had a client who was looking to sell their business. We did a search. We interviewed 3 investment banking firms, specialists in his field. So we're very focused on our process. And after he selected the investment banker, I dropped down to the CC line and just monitor the traffic.
Sure.
So that way when the founder goes, hey, I got a question, I go, I'm up to speed. The investment banker and I speak behind the client's back, because we want to have high-level conversations without having to explain or do or share. So this issue came up. He was caustic. He was a great person, but he was caustic. He was aggressive at times, and it was just his personality. He wasn't mad or mean. It was just how he came off.
Or sometimes I've seen it to where the actual thought of selling or doing a transaction brings that out of people. I've known you for years and I've never seen this. Who are you? Say, who are you right now?
And fear creeps in.
Yes.
Uncertainty creeps
Yes.
in. Nobody likes uncertainty.
Uncomfortableness. And
so the banker and I have a frank conversation because we know that we have to put this founder in front of potential suitors. And so we did work from a, I don't want to say good cop, bad cop perspective, but we both decided this is how we're going to express this to the founder, that here's how we want to project ourselves as we communicate. My piece was pretend like you're an actor. I needed him to be able to put on a face. The banker came at it from a different way. And we also recognized that meetings couldn't be 3 hours long. Okay, so again, we look at the situation and go, how can we have the best success? What's the magic formula for this founder, which is different than the founder before? And so we would have 40, 45-minute, hour meetings with potential buyers.
then just get them out of the room.
And then we're like, okay, yeah, we have another appointment. We can have another one, but we just didn't want to have that opportunity to where, for whatever reason, we saw that personality come back. Now, the great part about that whole transaction is he was selling the business, and this is also one of the things founders don't do. He was selling the business, and they didn't need him to stay at the business because he had already hired and trained his replacement.
That's great. Yeah.
So on one hand, the buyers weren't going to be working with that owner, but also helpful because of his communication style and his nature. If it would have been a much different conversation or story had he had to stay. Then we have to be like, okay, so this is the personalities, right? You got to make sure it fits.
You're going to have to live with this person for a year, 3 years, 5 years, because decisions are going to be made or information will need to be procured from him. And so in that instance, you disclose, you say, hey, look, sometimes, or how do you handle it?
In that instance,
such a soft,
yeah,
right?
I think, again, personally, I like speaking about the future. That banker and I would have had a conversation around how do we communicate his personality to the suitor, not in the first conversation, but when we begin to winnow it down and we begin to get offers and we narrow those down, then we'll be able to have that conversation a little deeper, more around personalities, preparing those suitors for who they're going to be talking to so that they're not surprised. So if we tell them in advance, then there's less of a shock.
I love that. You have to do that. It's a tough conversation, and I guess it does make sense to wait until you've winnowed it down, and maybe there's a little bit of a relationship that's been built. Maybe they've seen it a little around the edges, and so they expect to hear it, and maybe it's something they can live with because they're so far into the deal that they know they want to consummate. Do you see a high percentage of founders regret selling their business? Okay.
I don't. There is a lot of conversation around that transaction and about the end of that business. And it's no different than I have clients that aren't founders that have been, let's call it civil engineers for 35 years. And they're like, I want to work a little less, but I still enjoy what I do. All of a sudden, they have a consultancy. They're working part-time. They're working with their same clients that they worked with for years and years. They have their own business. They're 60. They can travel and they can work. Same thing with that founder. The founder, again, if they're that entrepreneurial founder, they've got other ideas. They have other things they want to do. And so we have a very good conversation around, okay, the wire's going to hit. What are you going to do? How are you going to think about it? How are you going to talk about it with your kids? What examples do you want to show to your constituents, your family, your employees about next steps? A case in particular, there was a company, the founder had started this company had raised a total of $3 million. And he had developed this system, and so he built this up, put a network in place, and he was grinding away. And I met him at a founder event. And he says to me, I think, now, first conversation, 30-minute conversation, he goes, I think I'm going to be getting an offer for my business. And I said, okay. He goes, I think it's going to be around $100 million. Okay. Now, he's raised 3, and now he has a valuation of 100. I said, what's our time frame? He said, I'm hearing that I should get this in 4 or 5 days. And I said, do you care about paying taxes? He goes, I don't want to pay taxes. So that was right then and there. We literally had a sprint. The following night, we had a dinner because it was the only time that my tax attorney could meet The next day he went to Mexico for his family vacation. We went to dinner and we hashed it out. And we created a structure that allowed him, he lived in a high tax state, that allowed him to not pay tax on the transaction in his state, which was a 10% savings.
That's huge.
Now, we had to create the structure, right? We had to seed it. We wanted to sit as long as possible so it didn't look like
Avoidance.
And then we also created for him 4 daughters. So we created a family foundation with the focus on the 4 daughters and they being involved in the foundation to learn about money, to learn about the value of money, to give money away, to provide for others that aren't as lucky as they, a whole incredible learning experience. And that's where we're able to affect that next generation with positive financial habits, with a positive outlook, with we are gifted, we should help. A whole set of values that they can adopt or not, but that are offered. And I have to tell you, founders who are parents, they just light up because they don't know how to teach their kids about wealth.
It's nothing you learn
unless you grow up with it,
or you literally have to have gone through it. You're right, and it's amazing how many stories you see where that step is not taken, and that wealth that they worked so hard to pass on ruins the next generation or two.
And on that, I do a lot of work around protecting kids. I was 17 when my father passed away, and then filed a lawsuit against his brother, my uncle, when I was 23. I hired a law firm, a probate estate planning law firm. We spent 5 years in pretrial discovery.
Wow.
And then went to court for 6 weeks. Now, story's a little different. My dad's brother committed fraud on his brother, but that stuck with me in terms of me being at that age, having this situation. Founders that get a lot of money, again, it's relative. I want to make sure that the trusting mechanism for the kids is dialed in. For instance, the client who's worth 1.8 billion, right? We had a rolling trust setup to where kids would get it a little bit at every age, but they would never get control of the massive pot. They had access to it, but not control. We put situations in almost every document to where we want to make sure those kids can't lose that money as best we can. Divorce, a lawsuit, bad investments. We want to protect them from themselves because we understand that if a 30-year-old all of a sudden has $500 million or 200 million or 100 million or 50 million or 20 million, pick the number.
Doesn't matter.
It's going to impact their life.
And they can lose it like that.
It's going to impact their life. And if they're not trained, it's heavily weighted towards the bad stuff, not the good stuff.
And then you also add not only their decisions, but then all the bad actors who come at them. Hey, buddy, thank you for sharing that story about your brother and the fraud he committed against your father and the lawsuit that you had to entail to unlock or unravel some of that. I can't imagine what that was like. Would you say that's your primary driver for what you're doing now?
Oh, without a doubt. Now, it's not an apples to apples comparison, but what I realized then, what I realized throughout these years, is that we can have a significant impact by using the tools at our disposal, whether that's estate planning, whether it's tax planning, psychological planning. I could go on, have studied, and it's the one thing they don't teach you as you're learning this business is the soft side. All about economics, all about financial planning, fiduciary, markets, money making for the client, returns, safety, risk.
That's the focus.
That's the focus.
But it's only one part of what you're actually doing if you're good at it, right? Because you can cover that, but not hit the mark.
Now, keep in mind, some clients, that's all they want. They may only want that piece. They may not want the softer help. But from my perspective, I haven't had a client or somebody who wants to work with me go, yeah, no, I don't want to know how to make the path smoother for my kids after I sell this for I don't want to know that.
It's a rarity to hear that, I'm sure. So you gave the example of the individual who had $700 million potential sale and the financial crash hit and he made some changes and then exited for 1.1. And and then the other example you gave. But what's the most expensive mistake you've seen a founder commit during an exit?
Early on in my career, I was put in touch with a gentleman who owned manufactured housing sales companies. So he sold the manufactured houses. All right. Now he was diversified, so he also owned some parks as well, because it's a very lucrative cash business. He was selling his business for, at the time when he came to me, he was selling it for $6 million. He had an offer for 6. Now, this is another gentleman who was a phenomenal salesperson, knew this industry in and out, but didn't graduate college and did not understand financials, balance sheet, P&L, all this kind of stuff, right? It wasn't his strong suit. He didn't have a strong team because he didn't understand the importance of that stuff, so he didn't have a strong team. But that's how I found him. So I grabbed his books, I did my math, and I put him in touch with, at the time, this amazing business attorney, respected in town. He had, I bet at this point he was 65 or 70. He had done a ton of incredible deals, just a legend. And I was able to get connected to him, have a phenomenal conversation with him to get him to take this client. I put him together. We ended up doing the deal for $21 million instead of 6. He had a bunch of cash that he wasn't understanding how it should be counted. And it was a third cash, a third stock, and a third note. Now the stock and the note were in the company. And I said to him, I said, I don't like this structure. We've got 2/3 tied up in the company still, and
it's not really an exit.
And this, the third you got in cash, you don't get to keep all that. You got to pay tax. Okay, and so he ended up with a very little amount of cash. It's a cyclical business. They ended up going to zero. They ended up restructuring a note into stock, but he ended up not transacting. He didn't get the other 2/3.
Wow.
Now, I wasn't strong enough in my conviction. I wasn't pounding the table hard enough, in my opinion, but it was just a bummer.
Sometimes you can pound the table all you want. It's not going to make a difference, right? There are some people, some clients, at least in my experience, who just look at, this is a risk. And they're like, it's going to be fine.
And the thing is, as humans, we are innately overconfident. Yeah. Just, it's plain and simple. I bet this transaction was 25, 26 years ago. About a month ago, my phone rings and his name pops up. I was like, oh, I hadn't heard from him in years. We've traded back and forth, but I picked up the phone and we started having this phenomenal conversation, and he recounts from 25 years ago the value I provided to him, and that he's calling me now because he had a question about that transaction. Somehow I remembered, was able to answer the question, but then his net worth now is $100 million.
Wow.
So he kept growing, and I said, of course, I said, do you have it all sorted out for when you're dead? And he laughs, and he goes, no, a bunch of kids. It's crazy. And I was like, you know this. He goes, I know, I just don't have the motivation. And I said, okay, I'm going to call you after the first. And we've traded messages back and forth because he needs that estate planning. And so I will help him with that estate planning, even though it's pro bono. I don't charge an hourly rate, but I'll get him dialed in. I'll get him the attorney that he needs. I'll get him the framework, and then I'll push back and go to the CC line and make sure that he gets it all dialed in. I know his kids, I know his ex-wife, right? So there's a lot of familiarity there, because I know that it would be criminal, right, if he...
What would happen to all the assets and whatnot. So interesting. Do you think he learned from that first? Did he say anything about that first transaction and what he lost, and did it impact him? Maybe he didn't share?
I didn't ask him about that transaction and how it impacted him. That's a great question for me to come back to him with. But yeah, I don't know.
You hear these stories, and in my experience, I meet people who've had stories like that, and it never happens again. Like, they learned, right? There's nothing like learning trial by fire. It's okay, I saw what that yielded and what happened to me. I'm never putting that much on the table again. And And maybe if I am, there's a parent guarantee or some other collateral that I can go after, right? So many different ways you can structure deals.
Without a doubt.
Back to family succession, why do you think so many family succession plans fail?
Oh, because they don't have a point person to help them navigate the emotions, the finance, the elephants in the room, he beat me up when I was 4 and I'm still mad. We all have stories that we could be like, I think, again, it's them not recognizing what's in front of them and them not recognizing the difficulty of the task in maintaining everything. So again, growing up, it was my uncle, my dad, they had a sister. My uncle had 4 kids. My aunt had 3. There were 2 of us. So we had this cousin group, that next level of cousins. And as a family, we did every holiday together. We were raised Jewish, so we did all the Jewish holidays together. We had friends from the business come. We had 40 people, extended families, and we did Thanksgivings where we'd watch the Cowboy game. So it was very integrated, and there were never, again, there might have been, but I never experienced or saw infighting. We never saw, I'm mad because of this, or I'm going to block, or my answer is no because of that. What's interesting is that my father and his brother, my father decided that because my uncle had 4 kids and he had 2, my uncle could take more money out of the business. And that was their way of, it's a really tough situation to think about because there are inequities at a bunch of places. Those kinds of things help, giving up for the good. I think that making sure that you have, I'll use the term psychologists on board.
That's what it is.
To help with that. And look, it depends on the size of the business. It depends on the table stakes. It depends on how many families are in the business. The old story, I think the first generation grows it, second generation blows it. No, third generation blows it. That second or third generation has to have that same passion.
There are very few families who can take it out far. I read the book on the Budweiser family, and I think they hit 4 generations, which was amazing. And what they did and how they parlayed it into Busch Gardens and everything like that. And then there was just a couple of people who made bad decisions, became alcoholics, and it destroyed it all. So your succession planning is extremely delicate. There is a tremendous amount, there's math involved, but there's a tremendous amount of psychology involved.
Everybody has to be aligned, right?
Yeah, and the odds of that happening from one insular family group. It's
DNA.
Yeah, exactly. It's different from a company where you're cherry picking people and saying, oh, your personality fits our group, and and your experience, it's accretive, right? But then you have a family and it gets toxic sometimes, especially when personalities get involved.
It can, no doubt.
If you could give every founder a piece of advice before they exit, what would it be?
Just, I would say, and this is hard to do, but I'd say just understand what the future looks like. A lot of business owners, I'll ask them, have you done any pro forma? No, what's a pro forma? Well, here's what I would love for you to be able to do with your CFO or CPA or whoever you work with is, let's model out 3 more years of this business or 5 more years of this business. And let's look and see where that falls out. Once I get them thinking about the future like that, and I get them to project out, then that's the kickoff to them thinking about planning.
Okay.
Because it's when you're going on a vacation, you're going to Orlando, you're like, I'm getting to Orlando. And then I'll figure out what I'm going to do. I'm going to get to Orlando. I'll probably go to Disneyland. I know I'll go there. Some people plan it all out. And so owners or founders are like, okay, I'm going to get to the sale. Oh, what? Your life doesn't, we still got, so if I can get them to think past that, whether it's a hot button around their kids planning, whether it's a sale or what's the process, then I'm able to get them to think forward. What I would give every founder or business owner today, and this goes off our topic a little bit, is start using AI in your business. Now, I don't know what the statistics are today on business owner usage.
It's very low.
But I'll tell you from my experience, and I've adopted AI where appropriate, and I started with chat when it first came out, and I've used Gemini, and now I'm using a Claude. And you should be thinking about where in your business you can streamline processes, and you can begin to use AI, because I guarantee you, your competitor's looking at it, And if you're not using it today, you will be lapped and fall behind. Because I see it.
I 100% agree with you. It is probably the most powerful tool since the word processor or something. It's just astounding. The crazy thing is it's in its infancy. It is in its infancy, and we're just finding out utilization. There was an article in the Wall Street Journal or the New York Times last week, and they had a chart of what percentage of businesses adopted it, and such a low number. I was astounded. And even of the ones who have adopted it, they're still trying to figure out how it can help monetize. I'd like to close out about your work, what you're doing with Pinnacle Wealth Advisory. You're here in Austin. Are you Austin? Are you Texas? Are you US? What are you focusing on client-wise?
So I have clients outside the US as well. I'll work with founders and owners all over the states. I get referrals all over the states. I love this Austin community. It is an amazing community. It is helpful. It is kind. It is giving first before asking. It's just been a phenomenal community to get involved in. And so my focus is on our ecosystem. So I spend a lot of time with founders. I spend a lot of time with startups. Most of them have raised some money, so they've got some heft behind them. And I spend a lot of time with those founders who I'm helping them begin to think about opening up their blinders. I went to Austin Tech Council pre-South by Southwest thing last night, met some founders, and some of the fun I have with founders is asking them, have you done any estate planning? And do you have a will? Do you have a partner?
And these are founders. They're like, I'm here to talk about my company I'm launching. What are you talking about? I'm not thinking about 3 decades down the road. So they just have a blank face.
They do. I'm saying, do you have a partner? And they're like, I have a partner. Okay, so let me just give you this. You're 50-50. You don't have a agreement. You don't have, it's not papered the right way between you. And then your partner dies and you're only a 50% owner and you can't make decisions.
Not to put a cloud on the room, but
no, you got to think about that.
Yeah.
So it's Austin. I'm focused on Austin. But I have engagements in Dallas. I have engagements in New York City. So
are you industry agnostic, or are you pretty across the board? Do you like to niche down, or?
That's a great question. In my education and my training, I learned economics selling widgets. That's the thought process around economics. We're selling a widget. And so it doesn't matter if they're selling wine, SaaS, right? They still have revenue, cost of goods.
And the same issues for estate planning and succession and exit. And pretty much universal.
Now, where we'll niche down is when we're looking for those bankers, we will find investment bankers who are in their space doing deals because, and this is really important, for those founders and owners, the value of a bankers trade in information. So if I'm organizing a meeting with a banker and a founder and myself, and I'm going to run that meeting, and we've signed NDAs, I want the founder, we want to learn all we can about the sector, about the industry, about the competitors, about the models, about the pricing, because they're all private companies. So we get all this intel. We want to tell the banker all about our company, because the only way a banker gets paid is if they do a transaction. So if I interview 3 bankers and I pick one, the other 2 are still out there looking for people, right? If they bring a buyer, they get paid. That helps a lot in terms of getting that founder to think about the future and to begin to think wider. And so I've developed an incredible network across the country of attorneys, CPAs, tax attorneys, just all down the list, because I want to be able to match up deal sizes, industries, and if I can, personalities, because we want everybody to get along towards a common structure or a common goal of
getting a
successful transaction.
So I'll include your LinkedIn profile, but is there a website? Is there a better way to contact you?
Yes. So my website is pnwadvisory.com, and you can reach me on my LinkedIn. The website's got a bunch of links. I'm always open to having that initial 30 or 45-minute conversation with a founder. There's no obligation, right? It's private, it's confidential, and what typically happens is that founder is going to learn a lot. Depending on the path they take, that's great. If they come back, great. If they don't, that's fine. It's just empowering those founders to be able to make better decisions around their business, their life, their world. It's easy for me to have a conversation with someone and help them along.
All right, Doug Greenberg, thank you very much. It was a great conversation. Appreciate your time.